Hello and welcome to Market Domination Overtime. Stocks closing lower as investors rotate out of tech. Jared Blickery over at the Wi-Fi Interactive with today's moves. Jared.
Thank you, Josh. A lot of rotation out of stuff today. I'll show you a couple places where it was rotating into, but first the majors was not here. Dow down about 166 points or 1/3 of 1%. NASDAQ Composite saw the brunt of the selling today. Tech was worse off in the sector action by far. That closed down almost 1.5%, and the S&P 500 down about 0.8%. Very similar looking chart there. And I'll show you the Russell 2000 too. Even the small caps, although that looks like might have closed to the upside there, so potential misprint. Let me just show you the Dow Jones Industrial transports though, because the transports were up 2% today, and if you include the price action from yesterday, they were up 5%. So pretty impressive showing there, and that's one of the places where investor money was moving today. Here are the large cap sectors. Energy, by far and away the best performing sector of the year, was also the best sector of the day, up 3%. Following that, we had materials and then staples and then utilities and industrials. And 4 out of these 5 closed at record highs. That would be energy, materials, staples, and industrials. Only utilities did not close at a record. And by the way, energy just recently closed at its first record high in about a decade or more. So it's been a good ride for energy. Here's tech down 2.2%. Also communication services, that's your Alphabet and Metatrade. That was down about 1.6%. And here we're looking at a lot of red on the mega cap side. Tesla just barely eking out a gain there. But let me drill down into the semiconductor space. We've seen on days when software hasn't done well, we've seen semiconductors do well. For the most part, not today, although we did see 7% up for Western Digital, 5% or 4.5% for SanDisk. And here's your software trade. Just a lot of dark red there, getting kind of nasty. If I were to show you the year-to-date totals, which I will do in about 30 minutes with you, Josh, you will see there's a huge dichotomy that's only growing between software and chip stocks.
All right, thank you, Jared. It was a tough day on Wall Street, but my next guest is betting on growth this year to drive gains. Join me now, we have Eddie Ghabour, Key Advisors, Wealth Management, CEO and co-founder. Eddie, it is great to see you. So let's start big picture here, because a core 2026 theme for you, Eddie, you say, bet on the economy. Now, the Atlanta Fed GDP tracker here, we are at 4.2. We got a 4 handle, so we look resilient. But what are the signs, the signals, Eddie, you look for that say, yes, that confirms my view of the macro?
Well, one of the biggest signs we're seeing is in the market. When you look at the market and what it's telling you right now, when you look at industrials and home builders and small caps, regional banks, the things that are most sensitive to the economy are really outperforming the broad market. And a lot of times markets are forward looking, so they are telling us what the future is going to hold. So we think the economy is going to really re-accelerate. One of the biggest things for small companies and that I talk to around the country is some recent tax changes. This accelerated depreciation that they're going to be able to get this year is a huge windfall for them. So, and you have a Fed on top of that that's being very accommodative. It is a perfect storm for growth to accelerate and exceed expectations. And the market structure is so overweight and concentrated in tech. As these areas continue to outperform, institutions are going to be forced to sell tech to rotate into these areas, because that's where the most concentrated trade is in the market today.
So that's your view of GDP. What's your view of the labor market, Eddie? Which is cool, although also we heard Jay Powell say, listen, some signs of stabilization.
I think the labor market's going to kind of stay right where it's at. It's not very strong, but it's not very weak. And it's kind of, again, that perfect storm for the Fed to continue to be accommodative. Because with AI, as powerful as it is and profitable in productivity, it's also replacing jobs, and some of these jobs are not going to come back. So we don't see the labor market as a threat to a recession, but we don't see it coming back strong either. So it's the labor market's going to stay where it is and maybe get a little bit weaker, but we think it's a Goldilocks scenario from an economic standpoint.
What are some risks to the macro? Like your clients ask you, you spell that out for them. They say, Eddie, what should I be looking out for with the macro? What are some possible potholes there?
So I think the biggest pothole is inflation. The economy gets too hot and inflation reaccelerates, which takes the 10-year bond north of 4.7 going to 5. Interest rates are the biggest risk to this market. And so that is the biggest risk. We do think ultimately there is a probability that could happen 12 months from now, because there is a such thing as too hot of an economy. So it's going to be a really tough act for the Fed to be able to handle both ends of that spectrum.
You mentioned the Fed. What did you think about Trump's pick there? Trump has said, listen, Kevin Warsh, that's my guy. That's who I want leading the Fed. Did you like that pick? Was that a good pick for the markets?
He was not my top pick.
Who's your top pick?
So,
Who'd you want? Were you a reader guy?
Reader.
Yeah. How come?
Because he knows the bond market as good as anyone. And our biggest concern with inflation accelerating is you could have some issues in the bond market. And with his expertise in that area, I thought he was going to be the one that was most suited to be able to handle this environment that we're going to be heading into the next few
What
years.
about Warsh's kind of rep? You think him historically kind of hawkish, concerned about inflation, although now he seems to be moving with the data. What do you think about that?
So I think the market overreacted to how hawkish he actually is.
Why do you say that?
Because I don't see a scenario where President Trump brings in a new head of the Fed, and he's going to come in June and all of a sudden shrink the balance sheet by half. You know, he has a history of being against QE, wanting the balance sheet to be smaller on the Federal Reserve. I can't say I completely disagree with all of that, but I think that he will be doing it in a more methodical way that doesn't break markets. One thing the Fed always says is they don't pay attention to markets, but I think we know that's not true. Every time the market calls their bluff, they blink, and he won't be any different than any other Fed head we've had.
Let's talk about some portfolio implications for everything we're talking about here, Eddie. You rotated out of tech. Now, Jared was just telling us tech got hit again today. Why rotate out of tech?
Because there's so many other areas, for a couple of reasons. Tech, the bar is set too high for earnings, right? Going into 2026.
You've got valuation concerns.
Very much so. And other areas that are economically sensitive have been left for dead the last 2 years because everyone's been so consumed with the AI trade that the bar is set really low. And we're looking at the earnings of Russell 2000 companies right now. Their year-over-year earnings growth is over 20%. That is huge. That's part, in fact, because they were in pretty much a depression a couple years ago. So there was nowhere for small caps and other sensitive areas of the economy to go but up because the bar is set so low. And for tech, there's probably only a way for it to go, which is down.
Do you look, though, at some of the moves? Jared was pointing them out, though. I mean, software is getting nailed. I mean, just take your pick. Microsoft, ServiceNow, Salesforce, Adobe. Do you look at that and say that makes sense or it's getting overdone? I'm just curious to get your take.
It does make sense. I mean, it makes sense for two reasons. One is valuations. Here's another thing is these companies have all committed to spending billions and billions of dollars in AI. Our question is, where are they going to get this money from? I think they have overpromised in regards to how much they're going to be able to spend, and I think the market's going to start really holding their feet to the fire. Last year and the year before, these companies were growing based on assumptions of what they're going to do. Now they're going to have to actually prove what they're going to do.
It is, to your point, I mean, this earnings season, you've seen investors be a lot more discerning there. Meta gets reward, Microsoft gets whacked. Did you step out completely from Microsoft? Did I see that?
Yeah, we got out of Microsoft.
So you're betting against Satya Nadella and Amy Hood. Man, those are two first ballot Hall of Famers there, Eddie.
Not betting against them because we're not shorting them. We're just finding areas to put capital to work that actually has much higher upside. And so far, we've been fortunate and blessed that the moves we've made have worked so far. So
you're saying you mentioned something, small caps. Is it regional banks?
Yes.
So a lot of this comes back to it's small caps, regional banks, industrials, comes full circle, your view on the macro. It's positive, so I want to stay long.
That's exactly right. And the market is confirming that so far we are right and that the data is actually going to be stronger.
Eddie, great to have you, especially on set. Thank you, sir.
Thanks for having me.
Coming up, we're counting down 2 results from Chipotle. We also got AMD on deck. That's next on Market Domination Overtime. Time now for some earnings. Taking a look at Chipotle's fourth quarter results. They are just hitting the wire. Let's get you those numbers. Q4 adjusted EPS, 25 cents. The street was looking for 24 cents. Revenue, $2.98 billion. Consensus was $2.96 billion. Comp sales, negative 2.5%. The street was at negative 2.94%. Q4 operating margins, 14.1%. The estimate was 13.7%. But here's the issue. They see 2026 comp sales about flat. The street had been looking for that to pop about 1.8%. I think that helps explain this reaction we're seeing in the after hours here. 2026 new restaurants, the company's calling for between 350 to 370. Analysts tracking the stock had penciled in more like 357. Just looking for some commentary from CEO Scott Boatwright, what he has to say. He says, through our proven business model, prudent investments in operational excellence, and the support of a strong balance sheet, he talks about 2025 was a year of progress and resilience for the company. He talks about what he calls a dynamic consumer backdrop, talks about opening a record number of restaurants globally. He says they grew Q4 and full year revenue. Remember, the stock was interesting heading into this print. Since early November, it had actually popped about 20%, but even so, it was still down more than 30% over the past 12 months. We know consumers broadly do have these affordability concerns, and that's been a challenge for Chipotle and others in its industry as they try to navigate that dynamic, with the stock down here more than 10% in the after hours. Let's welcome in now Nick Setyan, Mizuho Managing Director and Senior Equity Research Analyst covering the restaurant sector. All right, Nick, so Chipotle just reported results, at least initially here. Investors disappointed. We got the stock down about 10% in the after hours. What do you make of these results, Nick?
The core itself was fine. It was slightly above expectations, but like you mentioned, the comp guidance for the year approximately flat, well below expectations of approximately 1.9 on the consensus side. Now, the street had been looking for an acceleration in comp in Q1 to date, the January period. Now, obviously, the 2026 guidance could be conservative. I think all eyes are going to be on what they say around Q1 and quarter-to-date trends, because the alternative data had actually looked pretty decent in terms of the January period before the weather hit. And so if they actually do talk about, an acceleration in the quarter-to-date period and imply that they're just being conservative around the 2026 comp guidance, the stock would actually go up at that point. But that's really the reason why it's down. The comp guidance was well below that sort of 2%-ish consensus expectation for 2026.
Nick, heading into this print, the stock was already down more than 30% over the past 12 months. You're down now another 9% in the after hours. There are all these broad issues, Nick, and you know this, of course, Americans dealing with these affordability questions and concerns. How is Chipotle navigating that dynamic?
They have turned to, they've pivoted to value pretty aggressively. December was an unprecedented month in terms of buy one, get one offers. Every weekend had a BOGO offer that actually led to some transaction growth acceleration, which is the reason why the comp came in at only down 2.5% versus that down 3% consensus expectation. In January, they did the whole protein menu rollout. With the sort of sub $5 price point emphasis, I do think that that actually gained some traction as well. And going forward, I fully expect them to be very promotional as 2026 progresses. They're going to have one extra limited time offer. They're going to push some of the LTOs like Al Pastor, which is coming out next week, to a month or so before the start of those same LTOs last year. So they're doing a lot of things to try to address that slightly weaker consumer backdrop.
So if you expect them to get very promotional, Nick, what do you expect to see for margins?
Well, that is a huge risk. I'm certainly below expectations in terms of 2026 margin, my four-wall restaurant margins. Again, we'll see how they talk about it on the call in a few minutes. But bottom line is, I think there could be as much as 100 basis points, if not more, of four-wall margin risk as 2026 progresses.
Talk a little bit more, Nick, about that product pipeline. What does CEO Scott Boatwright have in that pipeline that you think, okay, this could be something that excites consumers and investors?
They certainly believe so. That extra sort of LTO should be one incremental beef offering. I think 2 chicken this year, 2 beef. Last year it was 2 chicken and 1 beef. So beef usually does get a little bit more traction than chicken. So they're excited about it. Around some of the focus around loyalty, delivery, promos, digital. I think that's going to be a big lever that they try to pull as well. But the bottom line is, it should drive incremental sales, given the fact that they're going to be on with LTOs probably 3 months more than last year.
Nick, what about more broadly for the sector you cover? I know some analysts are looking to fiscal stimulus, tax cuts. They think, hey, that could be a tailwind for consumers, for customers that visit a Chipotle and others. Do you agree with that?
I do, but I think it's specific to the casual dining segment in terms of where the benefit's going to be felt, right? It's that middle income customer. It's you don't have as much of that immigration headwind because you do have to consider the immigration headwind. The White House is planning on deporting, 1 million plus customers essentially. Last year we went from 2.5 to 2.7 million net immigrants down to under 500K, but that was mostly around the border. This year, they're actually going to be deporting actual customers. I do think that's going to be a little bit more QSR customer, and even to a little bit a little more exposure for fast casual as well. So I think casual dining is the place to be. I think they don't have a lot of exposure to immigration headwinds, and they have very big exposure to that middle income customer who is going to be the beneficiary of the fiscal stimulus.
Nick, appreciate that instant analysis. Thank you.
Thank you very much.
Well, AMD fourth quarter earnings just now crossing the wire. Let's get to Yahoo Finance tech editor Dan Howley for the results. Dan, what do you see?
Shares are down more than 5%, but they beat on both the top and bottom line. We saw EPS of $1.53 on revenue of $10.3 billion. That was ahead of expectations of $1.32 and $9.6 billion. We also saw the data center revenue come in at data center revenue came in at $5.4 billion versus expectations of $4.97 billion. They also gave better than expected Q1 revenue outlook. The street was expecting $9.4 billion, but AMD says it'll come in between $9.5 and $10.1 billion. They also penciled in about $100 million of revenue potentially from the sale of their chips to China. So we're still trying to figure out why the street is negative now on AMD's stock price, despite this beat. Could be that it just didn't beat as much as they anticipated or perhaps wanted. This is all part of this ongoing AI trade where, we had saw these huge explosions in numbers. Now they're coming back down to earth, law of large numbers, obviously. And so that means that the growth over time is going to become a little more modest as we go on, but still a big beat here on Q4 and Q1 outlook.
All right, thank you, Dan. Appreciate it. Well, AMD reporting fourth quarter earnings moments ago. Let's get some analyst reaction here with Cody Akery, Managing Director and Senior Semiconductor Research Analyst at Benchmark. Cody, AMD just reported. What do you make of the results, Cody? What explains its reaction? Why are we in the red here in the after hours?
Well, I think it's just a matter of heightened expectations, especially after Intel missed so badly on their outlook, and they were supply constrained. The expectation was that AMD was just going to be killing it on market share gains, and I think they are. I think they're upside on data center by nearly $500 million, and data center shows continued strength in share gains. They're also seeing their client side business up 39% annually, and so they're seeing strength in data centers and in client. So I think they're just really able to take advantage of Intel's weaknesses and the strength of the broader market with AI leading the way on data centers and client being a relatively healthy space to be as well.
So that client segment, Cody, so that's chips going into laptops, PCs. One question there, and listen, it's not just a question for AMD, but this global memory shortage, Cody, and now people are asking, okay, does that mean PC makers, they're going to have to raise prices? That could dent demand and maybe impact AMD's bottom line. You've heard this. I mean, what's your take on that?
Yeah, there's definitely concerns out there regarding the health of the PC market this year, but like you said, with memory prices impacting consumer activity. And I think that's a valid issue. I think we'll see stinted demand throughout the year for PC units, but that's well known, and AMD continues to take market share in that space. So I think they continue to grow even in a softer market at the expense of Intel, unfortunately for Intel. But it really is all about the data center, the growth of their Instinct business, their GPUs. And I think that as 26 progresses, AMD starts to pick up momentum as we ramp into their new MI400 Series 455 and their Helios rack system in the second half.
So that's where I wanted to go, Cody, with you next. Is the products in the pipeline, Cody, the new GPUs, the rack scale server, that's taking direct aim at NVIDIA. How well positioned is Lisa Su's company here with those new products on the way?
I think they're very well positioned. I think in the back half of the year, we'll see the first real viable competition with NVIDIA's Blackwell platform. Now, this is still not behind. It's still a generation behind NVIDIA's most advanced systems, but it's the first viable competitor for a rack system in the industry. And AMD's products are likely to test NVIDIA's market share at a more price-sensitive entry point.
What about other competition, Cody? You think about AMD's own customers. You think about the hyperscalers, the big cloud giants, the Microsofts, the Amazons. What kind of competition could that pose for AMD long term?
Yeah, I think it's a valid argument. Broadcom is the leader in the ASIC industry as they're working with many of the hyperscalers. You're seeing really all of the hyperscalers invest in their own custom ASICs for a portion of their workloads. It's more of an inference game for ASICs, and AMD and NVIDIA are going to have their place in the industry with high-performance GPUs. I think there's room for both in a capacity-constrained data center environment, but it is an area that we're watching as the ASIC, like you said, AMD's customers are motivated to use their own internal silicon.
Cody, to your very good point, listen, expectations here were high. I mean, heading into this print, this stock had been a rocket ship, right? It was up more than 100% over the past 12 months. Just a remarkable run. I know you got a buy on the name, Cody. I'm sure you get questions, though, about valuation. You still argue, listen, it's attractive at these levels.
Yeah, I do. I think that as we ramp through 26 and they look at success of the launch of their Helios platform and we start to see real customer adoption, remember, they've got Oracle, they've got OpenAI commitments. They have customers that are on board and are committed to using AMD for the for the early generations of their rack scale system. And so I think as the market starts to see the fruition and the evidence of these years of work that they've been putting in to become an NVIDIA competitor starts to play out through 26, the stock will respond nicely.
Let me ask you a question about China. I'm just curious, what do you think the opportunity, not just for an AMD, but more broadly, the names in your coverage universe, what does that opportunity look like long term?
Well, I think that China opening the door, at least tacitly, for NVIDIA and AMD's processors is a positive. It's a nice revenue contribution for Q1. They're saying $100 million. I think that's a drop in the bucket for the broader Chinese demand with Baidu, Tencent, Alibaba, and ByteDance all looking to buy processors. So I do think that Chinese activity is going to increase as the year progresses, and AMD will be a viable player in that market. AMD is obviously still playing catch up a bit in that business to NVIDIA, but I think that as the year progresses, their momentum will build.
Final question, Cody. You got buys here on AMD and NVIDIA, but if I pushed you, Cody, would you say, listen, one of these is more of a buy? It's a strong buy.
Yeah, I think the rate of change with AMD is higher than what we'll see with NVIDIA. NVIDIA is fending off competitors like AMD and the ASICs from Broadcom, whereas AMD is really coming up from a minimal market share. I see AMD in their competition against NVIDIA very similar to what I saw with their competition against Intel a decade ago, where they came from nearly zero market share in the server industry to today, where they're nearly half of that business. Now, they benefited from Intel's mistakes, and I don't expect them to get the same hand up from NVIDIA that they saw from Intel. But I do expect AMD to be the share gainer in the space, and therefore its rate of change it will be more significant than NVIDIA's.
Cody, as always, great to have you on the show.
Thanks for having me, Josh.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned.